Good morning. Top three things in my notebook this morning. Number one, U.S. equity volatility, i.e. the VIX. Number two, gold. And number three, once again, the 10-year bond yield. So just to dig into the first one, this really matters. This rarely happens, but the U.S. equity volatility index is now rising along U.S. stocks. So last week, if you look at this for what it was, U.S. stock market up equaled VIX up, which doesn't happen very often. So again, I think that is precisely because people are starting to worry about growth slowing. So watch out for that. The upside down inverse correlation between volatility and equity is very important to monitor. Number two, gold. Gold is telling you explicitly that growth may in fact slow. Now, there's two different signals that go underneath that, which are a weakening dollar and falling interest rates. So again, if the Fed wants to not taper, they're going to get slow growth. And again, we just might buy gold on that. We'd like to see 1322 support hold, and a breakout line of 1352 is clear and present danger for the gold price. And then finally, the 10-year bond yield, which is again completely interconnected with what I just said from a VIX perspective, equity perspective, and from a gold market perspective. The 10-year bond yield remains bearish from an intermediate-term trend perspective. Number one, that's new. Number two, the line, which is what matters here, the trend line of 2.60% is now resistance. It was support, now it's resistance. So again, as bond yields break down and the dollar breaks down, we would imply that growth could slow here on the margin, and what happens on the margin in macro matters most. So those are your top three things.